why the markets crashed on October 10th and why it's struggling to bounce. So not only this week am I paying attention to the forward guidance from the Fed, but I'm also paying attention to the other things at the beginning of the call that I told you all in the coming days to be mindful of. But now also this. This, in my personal opinion, I haven't seen anybody on the internet, especially influencers, talk about. So these dates in the coming days ahead in our fundamental reports are going to be very, very important. Alrighty, everybody, what is going on? Massive week ahead in the coming days, and honestly, massive weeks ahead in the coming weeks. So we're just going to briefly talk about some things that I'm focused on as we shift into the new trading week for the month of December. Some things that I'm keeping on my radar as we progress into the 2026 new fiscal year. I want to really orient our attention towards some historical events that have taken place, why crypto and risk assets have reacted negatively in the past couple of weeks, taking a look at fundamentals, pinning them on the charts, going over the current market environment, and just speculating on the outcome of this week, given the fact that we have the FOMC release on Wednesday. Our primary focus is going to be on the forward guidance from Jerome Powell. We'll get into that here in just a second, but I want to take a look back and just look at what previously happened, what the market was expecting versus the reality that came about, and risk assets like crypto. We'll also take a look at MNQ today because I'm noticing some very interesting things. So I want to talk about those outcomes that could play out this week, talk about the landscape, and then just make sure that everybody has a thorough, broad understanding of things to pay attention to in the coming days and weeks ahead. All right. As you guys know, I have family coming this week. They should be here this evening, and that visitation will last until roughly about Friday this week. So as I mentioned, the Zoom call schedule for myself might be a little off this week. I will try to get Zoom calls out to you guys. If not, though, expect fundamental reports and updates from me in the fundamental section, as I will still likely be trading this week. All right. So just first, right off the bat, just in my notes, I mentioned any geopolitical tensions need to be on our radar. Any net new announcements via the Russia-Ukraine debacle, which we've been talking about in recent videos and Zoom calls. Any positive or negative updates on that forefront. More recently, obviously, of course, in the headlines over the weekend, we've seen China, Japan, and Europe escalation tensions. This ended up being a fugazi. We had Japan and Australia urged some calm after Chinese radar locked on Japanese jets this weekend. It fueled some slight market uncertainty, but the market has completely recovered from this event that took place that stirred some uncertainty in global markets. Here is that report if you guys want to read it. I dropped it in the fundamental section. It literally just goes over how it was a scare at first, but nonetheless, everything's calm now after the event that took place. We also had French President Emmanuel Macron warning that the European Union may be forced to take strong measures against China in regards to some ongoing tariff debates. We're just paying attention to any of these global catalysts. As we know, any one of these things could create a uncertain environment, and that could create a favoring and more demand for safe haven assets, which we know always usually tends to negatively affect risk. We're also paying attention in the coming days to Trump's nomination for who becomes the Fed's next chair. So you can see here in this Yahoo Finance report, it talks about how more Fed drama lies on the horizon. President Donald Trump is expected to soon name the successor to Powell, whose term as chair expires in May. Kevin Hassett, a Trump loyalist and senior economic advisor, is right now the frontrunner. But that's prompted worries among some investors that the next chair will pursue aggressive rate cuts at Trump's discretion, and that could risk spurring inflation, which we know, obviously, of course, long-term is not something positive for risk assets. So again, just something to keep on our radar in the days ahead. We always try to play chess with the markets. For example, we are now in the environment of a possible Bank of Japan rate hike. We've seen in recent trading sessions some strengthening of the yen, which we know has led to some sell pressure on risk assets, especially via the uncertainty that Governor Ueda delivered last week. And so we were talking about that months ahead. And so just like how now we're talking about these things way ahead of the curve, you obviously, of course, see that Jerome Powell's statement or his presence, excuse me, in the Federal Reserve won't expire until May. It's just something in the coming trading sessions and months ahead that we will need to keep on our radar. So I thought that I'd enlighten you guys and put that back in our focal point. But this week, all right, our primary focus is going to be on Jerome Powell's forward guidance via how the market starts to price in rate cuts in 2026. We already know that right now, via multiple bank reports from Wells Fargo that I've shared with you guys, even this one from Scotiabank or Scotiabank, however you say it, we can read thoroughly through this. But nonetheless, they agree with pretty much what I'm saying, is that the market's already priced in an 80% plus probability that we're going to see a rate cut this upcoming week. That's likely baked in. It's likely going to happen. That means the most important part will be the Fed's forward guidance. What does the market start pricing in after Jerome Powell's comments on Wednesday after the press release? So that's going to be our primary focus in today's video breakdown, going over those scenarios, talking through the current market conditions. Like I mentioned, we'll take a look at the total cryptocurrency market cap. I want to really ask you guys some thorough questions because we also have some other major things coming out in the coming days ahead that could be very bad for risk assets, especially crypto. If they did unfold, we'll talk thoroughly through those things as well. And then I'll leave you guys for the week. All right. So first, all right, let's just talk through this Scotiabank hopefully I'm pronouncing this correctly. Probably not butchering it horribly, but this reads so that way you guys can see it coming directly from a bank. The 2-day FOMC meeting culminates in a full suite of communications and forecasts on Wednesday afternoon after the Bank of Canada. The statement at 2 p.m. Eastern will be accompanied by a freshened summary of economic projections, including a revised dot plot of rate projections. Chair Powell's press conference follows at 2:30 for around 45 to 60 minutes or so. A 25 basis point cut to a new target range of 3.5 to 3.7 is what is expected. In fairness, we have stood rock solid behind that call throughout the whole period in which market pricing gyrated and Wall Street hopes or shops flipped back and forth on their calls. At this point, the most powerful argument to cut rates at this meeting are, and then it gives those reasons as to why they think the market's going to cut rates this week, or the Fed's going to cut rates this week, excuse me. But here you can see it highlights and says, with that being said, the market already pricing in the rate cuts, what's going to be the most important factor is the forward guidance is likely to matter more. It is expected to be highly scattered with a central tendency supporting modest additional easing in 2026 as implied by a range of views behind policy rate expectations. So this is extremely important because if this is what's already expected by the market is expecting a highly scattered viewpoint and a central tendency supporting a modest additional easing in 2026. Well, if Jerome Powell comes out and the market's expecting or pricing in right now a modest easing in 2026, but Jerome Powell comes out saying some excessively dovish stuff, and the market starts pricing in aggressive easing in 2026, we could see a Santa Claus rally, is what the markets call it, especially in traditional stocks, where heading into the new year, everything rallies. However, inversely, if we see a pushback on rate cuts in 2026, that could be negative. In other words, it was already a committee that was reticent to do much by way of easing going forward. It was already a highly divided committee at the last meeting, as evidenced by the dot plot published at the meeting chart. Back then, participants were scattered across cutting down to 2.75 and not cutting at all by sticking at September's 4% rate through the coming year. Sometimes similar is expected at this meeting. It would be very surprising if they showed any greater collective conviction on the path forward than they did in September, right? So this is talking about the September-October meeting. It's talking about how they pushed back on rate cuts. Well, if we pause right there and we go and we take a look at the charts, we've covered this in so many previous video breakdowns. Actually, as a matter of fact, on October 4th, when we had a Zoom call, when the total cryptocurrency market cap was hovering at 4.24 trillion, in the Zoom call that we had hosted back then, which you guys can go watch on our playlists, we specifically discussed and talked about one of the catalysts that would lead to a market correction is if we saw a hawkish Fed. And that was one of the catalysts that we got late into October that created some sell pressure on risk assets. And we've seen this before. So we're on the weekly time frame in the total cryptocurrency market, and you can see this massive bearish candlestick mid-December followed through with a bunch of bearish price action and a whole entire market correction of a previous rally was led by the exact conditions that we're seeing today. You can see it in the headlines. The FOMC's hawkish cut slams risk appetite. December 18th, 2024. Right? Well, real fast, just to go over the current market environment, two major catalysts that led to this recent pullback. Can anybody tell me what this one was? This was 10/10/2025, October 10th, 2025. One of the primary catalysts that led to a massive liquidation across all of crypto and other risk assets, including stocks. Does anybody remember this before I enlarge the fundamental report?
Wasn't it when Trump increased the tariffs on China?
Yeah, he announced a 100% tariff raise on China, on Chinese imports. And you can see that here. Good job, Kevin. Pat yourself on the back. October 10th, 2025, Trump announces new 100% tariffs on Chinese imports after stock market sell-off. The stock market sold off. And obviously, of course, crypto follows suit. Now, this was not the only thing that affected the markets negatively on October 10th. I want to thoroughly read through this CoinDesk article because it is going to paint a very clear picture for some dates that we need to be paying very close attention to in the coming days ahead. But that was not the only thing, this Trump announcement, that created this massive liquidation and cascading event in crypto. We'll get back to that. But nonetheless, why the sell pressure continued, after we saw that bounce back from that massive liquidation event, everybody got super euphoric and everybody got ecstatic that we were going to see a full-blown market recovery. However, we here in this community did not gravitate towards that. And we noticed that at the end of October, there was an FOMC meeting. And we, same thing that we're saying now, had let everybody know, especially in the reports, we said that if we want to see a rally into the year-end 2025 and into 2026, we need to see the Fed at the October meeting lean dovish and support aggressive easing. Well, same thing like we got in December that created and marked the beginning of this cascading pullback or risk-off mood, temporarily, of course. We saw that reflected at the end of October in that same rhetoric that Jerome Powell delivered in December that created a massive risk-off appetite is the same exact rhetoric that he delivered in the October meeting. So you can see that here. Fed cuts rates again, but Powell raises doubts about easing at the next meeting. This was from October at the end during the last FOMC meeting. You can see highlighted in red, it says, the Federal Reserve on Wednesday approved its second straight interest rate cut, which most retail traders think is going to flip markets immediately bullish. But what was important was his forward guidance. And then it says, though Chair Jerome Powell rattled markets when he threw doubt on whether another reduction is coming in December. So that is why the rate cut is not what's important this week. The forward guidance from the Fed on whether or not the market prices in aggressive easing heading into 2026, which could lead to some type of recovery rally, or the markets continue to price out the probability of easing and we start to continue to see strengthening in the dollar or other safe haven assets. And instead of a full-blown recovery, we see sideways price action, consolidation, or we see more sell pressure and a deeper correction of this previous bullish move, leading us down into lower prices below $2.8 trillion. That is the question this week, right? However, coming back to this event, because a lot of people think that the only cascading event that swept market uncertainty was the Trump announcing 100% tariffs on Chinese imports, but that is not to be the case. If you go and you look under the hood, there was much more catastrophe than what meets the eye, and we are now on the prospect of coming up to some of these dates. So it says here, this is from December 2nd, 2025, why the markets crashed on October 10th and why it's struggling to bounce. So not only this week am I paying attention to the forward guidance from the Fed, but I'm also paying attention to the other things at the beginning of the call that I told you all in the coming days to be mindful of. But now also this. This, in my personal opinion, I haven't seen anybody on the internet, especially influencers, talk about. So these dates in the coming days ahead in our fundamental reports are going to be very, very important. MSI's proposed reclassification and potential index exclusion of digital assets treasury, or the DAT, companies now looms over the market as a major structural overhang, says Dr. Afta Sahar, founder and CEO of STBL. This helps explain the lack of a sustained recovery in crypto prices since the October 10th crash. We had the biggest liquidation event in the market history on October 10th. Bitcoin nuked, ETH and alts fell even harder, and since then, every bounce has died on contact. Everyone blamed the US President Donald Trump's 100% Chinese tariffs, which again, we know, definitely was a part of the cause, but that's what the mainstream covered. All of those are valid expectations for why the market crashed, but they fail to explain why the market has remained perpetually depressed in the following weeks. This missing piece seems to be this missing piece seems to be a quiet document published the very same day by MSCI, the world's second largest index provider. It directly targets the structures that helped power this current cycle. Digital asset treasury companies, or DATs, like Michael Saylor's strategy, or NASDAQ, MSTR, and many others. Put simply, October 10th wasn't just tariff day. It was also the day that the market discovered one of its largest marginal buying groups might be structurally crippled in early 2026. What are DATs and why do they matter? DATs are publicly traded companies whose business is holding Bitcoin or other digital assets on their balance sheet. Think strategy-style vehicles that raise equity or debt in traditional markets, using that capital to buy Bitcoin or other tokens such as Ether, and in doing so, give investors a leveraged, publicly listed digital asset proxy. Since the first DAT emerged in 2020, with what was then called MicroStrategy's initial purchase of 21,400 Bitcoin in August of that year, DATs have become one of the major structural buyers of digital assets in this past cycle, or in this current cycle. These buyers fall into two categories. This is very important. Spot Bitcoin or other digital asset ETFs and related passive vehicles. If you guys remember what we touched on in a previous Zoom with one of our private members throwing out this theory that the ETFs were just a manipulative tactic by the market makers, this CoinDesk article, almost in my personal opinion, cements that thesis. If you guys were on that Zoom call, we uploaded it. I uploaded it for you guys last night. It was Friday's Zoom call. Watch the end of it. It was very interesting. And DATs that repeatedly issue stock or convertibles or use other forms of financing to acquire additional digital assets. Crucially, DATs have been benefiting from their index and exclusion game through a self-reinforced chain of events. As a DAT grows large enough, it is automatically included in the MSCI and other major benchmarks, which forces passive index funds to buy the DAT stock to replicate the index composition. This index-driven demand creates additional buying pressure for the shares, pushing the price and market cap higher. The higher market cap generated by the passive buying also improves liquidity and perceived legitimacy, giving the DAT the greater capacity to raise further capital via equity offerings, convertibles, or other financing, and uses the proceeds to purchase additional digital assets, further expanding its holdings and its market cap. In turn, the DAT increased market cap translates into a larger index weight, which attracts even more passive flows. Now, this is where it gets interesting. What the MSCI announced on October 10th. On October 10th, 2025, the MSCI published a consultation titled Digital Asset Treasury Companies, proposing that companies whose primary business is holding Bitcoin or other digital assets will be reclassified as fund-like vehicles rather than operating companies. Under the proposal, if a firm's digital asset holdings represent 50% or more of its total assets, it could be excluded from MSCI's main equity indexes. This consultation will remain open until December 31st, 2025, so we'll be paying attention to that date. That is the end of the year, with a final decision scheduled for January 15th, 2026. So there we have yet another important date. And any resulting exclusions set to be implemented as part of the February 2026 index review. So we'll be very mindful of all of this stuff up until about February till we get further details. But check this out. This is where it gets juicy. And this is what I'm talking about, where if it did unfold negatively, I'm not saying it is, but I haven't seen anybody talk about this. Again, mind you, this report is telling you how one of the reasons why we saw massive cascading liquidation events was because of the tariff announcement, of course, creating uncertainty. But if you look deeper under the hood, it was this event with the DATs, and it's not done. And if it's not done and it gets worse, be prepared for massive liquidations to take place. Analysts have run the numbers. JP Morgan, for example, estimated that removing a flagship DAT from MSCI indexes could trigger around $2.8 billion of forced passive outflows, rising to as much as $8.8 billion if other major index providers adopt similar exclusions. This is more than a passing headline for risk for crypto. If MSCI and its peers move ahead, and index trackers, pension funds, and other passive vehicles will be forced to sell those stocks, not because they dislike Bitcoin, but because their mandates and rulebooks require it. Looking forward, DATs would not qualify for passive index inclusion, just as funds and ETFs are not eligible as index constituents. So if the following timeline, the sequence of events around October 10th looks like this, then it goes on, talks about all these things, and then why in MSCI's move hits the heart of the cycle. So if you guys want to read the rest of this, I put this into the fundamental section. You guys can finish reading this. Nonetheless, right, it says here again, keeps giving us and reiterating these key dates. We need to pay very close attention to these dates in the coming days ahead. Okay. So this is just another thing on top of the FOMC announcement, the forward guidance, and all the other things that I mentioned that in the coming days ahead, I will be paying very close attention to and keeping you guys updated on as developments continue to unfold. Again, not trying to spread fear, uncertainty, or doubt or anything like that in this community. Nonetheless, hood that nobody talks about that keeps us ahead of the curve, because if they did unfold, say we have capital, now this to me gives me ever more reason as to my confidence as to why I'm still keeping some capital on the sidelines. I'm taking advantage of discounts now in the very moment, considering that we are discounted, but I'm also keeping some capital reserves on the sideline just in case that are sitting in stable coins, earning passive rewards. So I'm not missing out on any gains. They're not substantial. But if, say for example, this catalyst does not unfold, the market doesn't go lower, then I can just put them into an asset that generates yield. And even though I might not be buying at the bottom, I'm still getting in before, what is it? 8% of the population right now owns crypto assets. I'm still getting in before 92% of the population, even if I don't buy the bottom. You get what I'm saying? So I'm playing both offense and defense right now with the current environment that we are living through. All right, so real quick before we get into the price action. Here's the upcoming calendar this week. We do have Bank of Japan Governor Ueda speaking on Tuesday, which will be Monday's Asia session for us here in America, Tuesday morning for you guys overseas. Tuesday, we hit it off with some very important jobs figures. I believe some of this data is lagging from previous months due to the government shutdown, but nonetheless, it will still be very important. I personally don't think it'll have any effect on the FOMC meeting. I think that that's already set in stone for a rate cut, in my personal opinion, but we will be paying very close attention to this because it will, you know, at Jerome Powell's meeting, if this ADP data comes out, and it shows super optimism, well, when Jerome Powell gets asked questions at the press conference, I'm sure that some of the, commentators will probably ask Jerome Powell about the recent economic data that we've gotten, and Jerome Powell's comments on that economic data will be very important. So if this data comes out showing signs of resilience, we know that Jerome Powell's comments, again, could possibly lean hawkish, and we know via historical price action what tends to happen when Jerome Powell pushes back on rate cuts, especially when the market's already priced rate cuts in and is expecting continued easing in 2026. All right. So labor market data will be of key importance. We do have some inflationary data on the Japanese front to be mindful of that could definitely help steer the direction or the forward guidance from the Bank of Japan. In next week's meeting, we won't pay attention to the Bank of Japan's monetary policy direction until next week, but definitely still just keep it on the radar as central bank speakers from Japan are set to come to the limelight. Wednesday, obviously, of course, will be the press conference, the FOMC statement. Don't forget, day traders, especially for those of you all in the futures markets, the meeting doesn't happen until 2 p.m. If you're taking trades before this data and news comes out, don't force anything, don't rush anything. Understand, myself and Scalper have showed you guys that 15, 30 minutes after the press conference ends and the market volatility dies down, right before the markets close and roll over into Asia session, there's been great opportunities if you're patient enough and you wait for good entries, right? So just don't try to force anything on Wednesday. Let's see how that conference plays out. Thursday, we have continued labor market data focus with unemployment claims on the limelight. And then the remainder of the week is relatively quiet, which means that geopolitical tensions and headlines will come back into the focus over the weekend. And Friday will end with some FOMC speakers. Those comments will be important to pay attention to on any forward guidance that they might give heading into 2026 on the rate cut path and the state of the economy. All right. So with that being said, taking a look real fast at the total cryptocurrency market, I'm hoping that what has happened over the past couple of months in crypto is that the crypto markets have priced in all of the pretty much negative headlines that I just mentioned. Bank of Japan, rate hike, strengthening into the yen. The markets have already priced in stronger yen, yen carry trade unwinds, this, and that. Then when the Bank of Japan hopefully hikes rates next week, if they do, the market isn't shocked by it, and it's actually a sell the rumor, buy the news event, where everybody's been selling the rumor of a rate hike by the Bank of Japan. They actually hike rates, and then it actually just leads to a bullish catalyst because the worst case scenario was already priced in. That's one thing I'm paying attention to for a potential recovery in crypto. Other than that, outside of that, I would like to see cooling in the labor market data that we're set to get in the coming days ahead. That could help support a case for rate cuts heading into 2026. If we can see that, coupled with Jerome Powell coming out leaning relatively dovish or supporting continued easing into 2026, we don't see any geopolitical shocks, Russia, Ukraine, China, Taiwan, Japan, tariff update announcements come out, creating and stirring market uncertainty. That for me would paint a bullish outlook and a possible recovery in terms of sentiment this week, especially if the market can gravitate towards continued easing heading into 2026. With that in mind, in my personal opinion, based on where we could possibly recover to or from, as long as we hold above $3 trillion, I firmly believe that that is a very important psychological threshold, which you can see here, held as support in the past. It was a very important level in which we broke above, market retested, and rallied from. We have recently broken slightly beneath it. These two bullish candlesticks, buyers have clearly made an attempt to poke back above. We need to see them hold that as support. We need the sentiment to flip back risk on, and that could stage a recovery to rekindle some of the losses that we got or saw in October and November via this most recent market downturn. I don't personally see us heading into the new year over the next 2 to 3 weeks making a new all-time high in crypto. Like I mentioned, I think we still have a slew of uncertainty that we need to get through in January and February before we can expect a full-blown market recovery. But I do think that if the sentiment paints a better picture than the one it's painting today, and the markets can see some optimism come back in, that it could definitely open the door for a revisitation and a rekindling of some of the losses that we saw starting in October and rolling into November. If not, and we get the inverse of the scenarios that I just mentioned, any of the catalysts that I mentioned at the beginning of this call escalate from their current standing or unfold to take a worse and create safe haven demand. Any tariff uncertainty, don't forget we have announcements via Trump and Congress and the outcome via Trump's tariffs and the legality of them. We already know, we've covered that in previous video breakdowns. If those come out and Congress votes against them, makes them illegal, it's going to create a whole bunch of tariff uncertainty. All the tariffs that took place and all the peace agreements and the negotiations that happened in 2025 that kind of supported the market sentiment and cleared some things on the future trajectory of the tariffs that could possibly affect inflation and da 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 da. Well, if the court rules against those tariffs, Jerome Powell, or not Jerome Powell, President Trump's going to come back and he's going to have to defend himself and restructure things or whatever the case may be. Nonetheless, it'll most likely create uncertainty. We know markets don't like uncertainty, so just be mindful of that. Anything in terms of the Bank of Japan strengthening monetary policy or hiking monetary policy leading to a strengthening of the yen, more so than the markets currently and have prepared for, could create unwinding of yen carry trades, which we know could create global liquidity shocks in risk assets. Higher or stronger, more resilient labor market data, pushing back on the rate cut narrative, supporting the case for a stronger economic backdrop. Any hawkish rhetoric from Jerome Powell pushing back on the current market expectations of a 2026 rate cut earlier on in the year, that could all weigh on current market sentiment. Again, like I'm mentioning, hopefully all these things that I'm saying have already been priced into this recent bearish price action. And we see the market shake it all off and say, it's not that bad. We already priced it in, and we start to see a recovery. If we don't, that for me is going to open the door for a revisitation of these lows here. And we're likely to see $2.5 to $2.3 trillion come into fruition. That means a fail to break and hold above 3 trillion as support. We break beneath that, turn it into resistance, buyers get trapped, sellers become aggressive, sentiment sours or worsens from where we're currently at. That's going to open the door for these lows to be our next target. That puts us at about 2.5 to 2.3 trillion. If we break any lower than that, we'll likely have a Zoom call and talk about the environment before. But next on the radar, obviously, of course, will be the support beneath that. And that next accumulation for buyers doesn't come in, unfortunately. I know that this is painful to say, but at about 2 trillion to 1.9. Right? So just be prepared. I'm putting that on everybody's radar. Those are the scenarios this week on the higher time frame. Mind you, this is the weekly time frame, so none of this stuff, unless we see aggressive moves, is going to happen overnight. Mind you, again, from where we're currently sitting at to recover from the last October 29th meeting is roughly about $600 billion of value. I don't think that if we did see a risk on sentiment that would just flood in overnight, we probably see $100 billion one day, retracement the next, $150 billion the next day, retracement the next, another $150 billion. You see what I'm saying? It's not just going to be one straight candlestick. It'll definitely be a couple of days of volatile price action. But nonetheless, if the environment swaps back to risk on, a rekindling of the October 29th FOMC sell-off is on my radar for us to see prices come back to, which puts us at about $3.5 to $3.6 trillion to end the year, which will see some nice recovery gains on most altcoins if it did come into fruition. That's what I'm hoping for, but not what I'm personally marrying in terms of bias, right? If we go take a look real fast for all you MNQ traders, something that I'm paying very, very close attention to. Okay. Scenarios are going to play a huge role in MNQ's price action this week, especially the Fed's forward guidance. So just like risk assets that were hit hard with the change in sentiment from Jerome Powell versus what the market was expecting in terms of the rate cut trajectory, here's that Fed cuts rates again, but Powell raises doubts about easing at the next meeting. And this took place on October 29th. Well, if we go look at MNQ's price on October 29th, here it is. MNQ, i.e. risk, NASDAQ, basket of risk assets, most major tech stocks, right, in the NASDAQ, was hit by this sentiment. On top of that, we had the AI bubble fears and all that stuff. There was a couple of other lingering things that created market uncertainty in the NASDAQ. But nonetheless, stocks were affected, futures were affected, and MNQ or NQ, depending on which one you trade, took a piss. Okay? So we are now coming back up into that premium. And so again, this week, if all of this bullish price action, we know this week was driven by what? Markets pricing in the current rate cut. Well, if when price comes up to this premium where they sold from before and markets already priced in the rate cut, Jerome Powell comes out and delivers hawkish forward guidance and pushes back on rate cuts into 2026. In my personal opinion, what's likely going to happen is this is going to see some sell pressure. And this is likely a break of structure. And heading into 2026, we're likely to see a correction of this bullish move or possibly even a break into lower territory. Right? Inversely, if the market was pricing in rate cuts that got us here with this bullish recovery, we know that when they previously pushed back on rate cuts, the market sold off. If we come back up into this premium, everybody's expecting the market to sell off, but instead of pushing back on rate cuts heading into 2026. Jerome Powell supports rate cuts heading into 2026, and the markets start to aggressively price in continued monetary policy easing. I could see a few scenarios unfolding. Some manipulation for buyers to rekindle at discounted prices and then flipping bullish, or just a continued destruction of anybody who's taking sells and buyers just continue to push, hold this previous area of interest as support, and we see the NASDAQ and MNQ aim for new all-time highs, right? So two key scenarios on the higher time frame that I'm paying attention to is how price reacts at this premium. Does it hold as a premium? Does the market sentiment sour at these highs? Does Jerome Powell push back on rate cuts? How do any of the other determining factors for market sentiment weigh in to the market conditions this week? If we see any uncertainty start to linger at these highs and we come up into this premium, the only thing that will allot me to start selling at these highs is if on the order flow we see trap buyers on the daily and 4 hour. On the daily and 4 hour, we start to break previous day's bullish order flow. And then on the lower time frames, we see a delta held pattern to the downside at a sell delta and a break below sell dark pools. That equating on the lower time frame to lower highs, lower lows, lower highs, so on and so forth. But I need to see all those things happen before I just start to take sells from a premium. Do not be that guy this week that just thinks that because price is coming into a premium, that they're going to respect historical price and sell off. It is possible, but it is not guaranteed. And be the dude that blows his entire trading account because you were expecting this week. But what happens is the other scenario that I mentioned, and we get this. And you keep trying to sell and sell and sell, but in reality, the market's still bullish. So play it by ear if you're going to be a active market participant this week, especially for you day traders in this community. Make sure that you're very attentive. We are coming up to a very interesting area. So let's see how price action plays out this week. I would obviously, of course, as a predominant buyer in my trading career, like to see the scenarios where we turn some of these previous areas of interest here into a support for pullback buy scenarios to give us the best risk to reward for this overall uptrend to continue. This is what I would likely favor this week. However, I'm prepared to react if we do not get this scenario, and instead we get the inverse. And we see a sell-off. All right. Outside of that, that is all that I have for you guys in terms of this weekly update. Hopefully that opens the door for everything that we need to pay attention to this week in terms of the schedule data. We have jobs data and FOMC forward guidance as our primary, some lingering data on the Japanese front and comments from Japanese speakers as our secondary, and on our radar, any geopolitical or tariff related tensions or shocks that could create demand or less demand for safe haven assets. Outside of that, though, that's all that I have for you guys.